Investing isn't just about making money. It's about avoiding costly mistakes. One bad move can wipe out years of growth. Think about it. You spend years building a portfolio, only to see it decimated by one avoidable mistake. That's why we're here today. In this video, we'll dissect the 10 biggest investment mistakes using real-world case studies, data, and expert insights, so you can avoid losing thousands or even millions. We're going to look at the mistakes that could be holding you back, and I'm going to show you exactly how to avoid them. If you're serious about investing, watch until the end, because mistake number 10 is the most destructive of all. Let's be real. Everyone wishes they could perfectly time the market, buying low and selling high. Imagine buying Bitcoin at $1 and selling at $60,000, or grabbing Amazon stock before it exploded. But here's the truth. Even professional investors with decades of experience and teams of analysts fail at timing the market consistently. According to JP Morgan's analysis, if you missed just the 10 best days in the stock market, your total return would be cut in half. Missing just 10 days out of thousands can cost you half your returns. And here's the real kicker. The best days in the market often happen right after the worst days. It's when fear is at its peak and everyone else is selling that the biggest opportunities emerge. So what's the solution? Stop trying to predict the unpredictable. Instead of timing the market, focus on time in the market. Automate your investments through dollar-cost averaging. Stick to your strategy no matter what the headlines say. I've talked to so many people who jump into investing without a clear roadmap. They're just throwing money at whatever's popular or sounds good at the moment. Smart investors don't just wing it. They build portfolios based on a well-defined investment plan that outlines their goals, risk tolerance, and strategy. Determine your risk tolerance and time horizon. Think about asset allocation, how much of your portfolio you want to allocate to different asset classes like stocks, bonds, and real estate. A good rule of thumb is to subtract your age from 100. That's the percentage you should allocate to stocks. Write down your plan and stick to it, even when the market crashes. Having a plan helps you stay disciplined and avoid making emotional decisions based on fear or greed. Look, I know talking about fees and taxes isn't as exciting as, say, picking the next hot stock, but here's the thing. These seemingly small costs can eat away at your returns over time. A 1% fee might not seem like much, but over 30 years, it can cost you hundreds of thousands of dollars in lost growth. Let me give you an example. If you invest $1 million in a mutual fund with a 1.5% expense ratio, that's $15,000 in fees every single year. Compare that to a low-cost index fund with a 0.1% expense ratio, that's just $1,000 in fees per year. Over 30 years, you'll have paid $450,000 in fees with the high-cost fund compared to just $30,000 with the low-cost index fund. And don't even get me started on taxes. Short-term capital gains taxes can eat up a huge chunk of your profits if you're not careful. Prioritize low-cost index funds and ETFs. Take advantage of tax-advantaged accounts like Roth IRAs, 401(k)s, and HSAs. Leverage and margin are like financial steroids. They can amplify your gains, but they can also magnify your losses. It's tempting to think you can outsmart the market and juice your returns with leverage, but the truth is, it's a risky game that often ends badly. Using leverage is like driving a car at 100 miles per hour. You might get to your destination faster, but the risk of a catastrophic accident is much higher. In 2021, many traders using leveraged ETFs made huge gains, but when the market turned in 2022, they got wiped out. If you must use leverage, keep it to a minimum, no more than 20% of your portfolio. Never go all in with borrowed money, especially during bull markets. Slow and steady wins the race. It's easy to get caught up in the hype of the latest hot stock or trend. You see everyone on social media talking about it, the news is covering it non-stop, and you don't want to miss out on the next big thing. But here's the thing, chasing hot stocks is like trying to catch a falling knife. You're more likely to get burned than to make money. Remember GameStop in 2021? Thousands of traders piled into the stock, driving the price up to astronomical levels. But then reality set in and the stock crashed just as quickly as it had risen, leaving many investors with huge losses. The data backs this up. According to a 2019 study, 95% of day traders lose money over a 5-year period. The most successful investors focus on fundamentals, earnings, cash flow, and growth prospects. Instead of chasing the next hot stock, invest in companies with a proven track record of success. Avoid get-rich-quick schemes and stocks that are being hyped on social media. Diversification is one of the most important concepts in investing, yet so many people ignore it. Putting all your eggs in one basket, no matter how promising that basket may seem, is incredibly risky. Investing everything in one stock, sector, or asset class is gambling, not investing. In 2000, the dot-com bubble burst, wiping out trillions of dollars in investor wealth. Many tech investors who had bet heavily on the sector saw their portfolios plummet 80% or more. Similarly, in 2008, the housing market collapsed, taking down real estate-heavy portfolios with it. Diversification is about spreading your risk across different asset classes: stocks, bonds, real estate, commodities. Within stocks, don't just own tech stocks. Branch out into other sectors like healthcare, consumer staples, and energy. The goal is to create a portfolio that can weather any storm. Cash might feel safe. It's tangible, you can hold it in your hand, and it doesn't fluctuate in value like stocks or bonds. But here's the thing. Inflation is a silent killer of wealth, and holding too much cash exposes you to its erosive effects. Over time, the purchasing power of your cash diminishes as prices for goods and services rise. The data is clear. Over the long term, stocks, real estate, and other assets have consistently outperformed cash. It's important to have an emergency fund, typically 3 to 6 months' worth of living expenses, in a readily accessible account for unexpected events. But beyond your emergency fund, aim to keep the majority of your money invested. Remember, the goal is to make your money work for you, and that means putting it to work in assets that have the potential to grow over time. It's human nature to panic when the market crashes. You see your portfolio value plummeting, and everyone around you is selling. It feels like the world is ending, and you need to get out before it's too late. But the worst investors sell at the bottom and buy at the top. They let emotions dictate their decisions, buying high and selling low. In March 2020, the S&P 500 plunged nearly 30%. Panic selling was rampant, but the market recovered within months. Remember, the stock market is forward-looking. Keep investing consistently, regardless of the market. By staying invested, you give your investments the opportunity to recover and grow. Dividends are like the cherry on top of your investment sundae. They're payments made by companies to their shareholders, typically in the form of cash, and they can provide a steady stream of passive income. But here's where many investors go wrong. They withdraw their dividends instead of reinvesting them. They treat dividends like free money and spend it, missing out on the powerful compounding effect that reinvesting can provide. When you reinvest your dividends, you're buying more shares of the underlying asset, which generates even more dividends in the future, creating a snowball effect that can significantly boost your returns over time. Always reinvest your dividends unless you're actively using them for income in retirement or to cover living expenses. Most brokerage accounts offer automatic dividend reinvestment plans, or DRIPs, making it effortless to compound your returns. By harnessing the power of compounding, you can turn those small dividends into a significant wealth-building engine. You know what the biggest mistake of all is? Not investing at all. It's easy to get caught up in excuses. I don't have enough money, I don't know enough, it's too risky. But the longer you wait, the harder it becomes to reach your financial goals. Time is your greatest asset, and procrastination is its biggest enemy. Imagine investing $10,000 per year from age 25 to 65. By retirement, you'll have over $3.4 million. Wait 10 years, and you'll have less than half. Start investing today. The important thing is to start. So there you have it, the 10 investment mistakes that could be costing you millions. The good news is, now that you're aware of these pitfalls, you can avoid them and start building wealth the right way. Remember, investing isn't about getting rich quick. It's about making smart, informed decisions, staying disciplined, and letting your money work for you over the long term. Stick to a well-defined plan, diversify your investments, keep your fees low, and don't let emotions dictate your actions. And remember, the most important step is to start investing today. Avoid these 10 investment mistakes. Comment below, what's the worst investment mistake you've seen? Like, subscribe, and turn on notifications for more investment insights.